I've been working for 3 decades, traveling for 2, and studying for 1. And the most important thing I learned? I don't know shit, but I know a lot of people that do. A valuable skill that you better learn very quickly if you want to preserve your safety and or wealth is that you need to figure out if somebody's a bullshitter or a straight shooter very quickly. Maybe one of the straightest shooters in the world of investing is Mr. Warren Buffett. Today we're going to look at what might be some of the last words of wisdom from Mr. Buffett. We'll also look at how Berkshire Hathaway did in 2024. Even if you're not a Buffett fan or you're not invested in Berkshire, I promise you're going to learn loads. So the first thing you'll notice when you go to the Berkshire website is everything's very simple. So you can navigate to where the annual reports are. It's all very intuitive. So the old acronym says, keep it simple, stupid. And Buffett has famously said that he won't invest in things that he can't easily understand. And if you look through the various bits of collateral provided by Berkshire, such as the annual report and accompanying 10K, it's all very easy to follow. Now, Mr. Buffett, in his most recent report, talks about how this gentleman, Greg Abel, is going to replace him soon as CEO. Mr. Buffett is now 94 years old. He talks about how this report is what is owed to Berkshire shareholders and how if you start fooling your shareholders, you're going to start believing your own BS as well. And that becomes quite dangerous. So speaking of believing your own BS, it's an interesting statement here from the annual report when Buffett talks about operating earnings for Berkshire. He says, EBITDA, a flawed favorite of Wall Street, is not for us. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And it's not important that you understand any of that. What's important to note is that EBITDA is not a standardized metric. So this allows companies some leeway in how they report it. And I think a great example of that would be the adjusted earnings per share we recently talked about in our piece on Archer Daniels Midland. As Buffett says, adjusted earnings per share makes us nervous. Now, in this report, Mr. Buffett refers to page 68 of the annual report, and that's what we're looking at here. And this is very important. So this would be the GAAP reported earnings from Berkshire, and this line that I've circled here, investment gains and losses. Buffett pretty much considers around half of their GAAP reported earnings impact to be just noise, and you see the highlighted line here. It harkens back to the old saying, the quickest way to reduce volatility in your portfolio is to stop looking at it. So all this reflects would be the mark-to-market gains and losses for the stocks that Warren Buffett holds. And as he correctly says in his annual report, this short-term noise means nothing. Market volatility, stocks will move up and down. They wouldn't be holding these stocks if they didn't expect them to show a profit in the future. So it's the same thing that you see all the instant analysts out there hanging on earnings calls. These mean nothing. You're much better off checking in with firms at a much longer cadence, for example, annual check-ins as we do here at Nanalyze. Now, when Buffett talks about earnings, he says some interesting bits. So 53% of his 189 operating businesses, we'll talk a little bit more about those, reported a decline in earnings. He talks about a predictable gain in investment income from all the T-bills that he's holding. He says their insurance business has delivered a major increase in earnings, which we'll look at, led by the performance of Geico. So that might be something to dig a little deeper into. And he talks about this gentleman, Todd Combs, reshaping Geico in a major way. He says Geico was a long-held gem that needed major repolishing, and Todd is working tirelessly to get the job done, though not yet complete. He says the 2024 improvement was spectacular. Well, let's take a look at that then. So when we go back to that earnings table, and of course we're ignoring the investment gains and losses line item, but we can then start to look at the other line items, the one at the top there, insurance underwriting. What you can do is just Control F that number, and what it will then take you to in the 10K is another table that shows a breakdown of the insurance businesses that represent this insurance underwriting segment. And you see the majority of the underwriting segment is Geico there at $7.8 billion in earnings for 2024. what you can then do is search even further in the 10K, and you come across a table that shows the details of Geico's underwriting earnings, and you see that here. So it's very simple to follow. You have premiums written, premiums earned, so that would reflect the money that they've captured. Then you have losses and loss adjustment expenses, underwriting expenses, so that's essentially the costs there. And you can subtract from premiums earned the total losses and expenses and get yourself a pre-tax underwriting earnings of $7.8 billion coming from Geico. You can then compare that to the previous year, and you can see the outperformance that Buffett's talking about. So it's very easy to navigate your way through the 10K and figure out what this business is doing. Contrast that with a firm like Brookfield, which we covered recently, stating that it's far too complex a company for your average retail investor to navigate. Many were quick to respond, well, it's just like Berkshire. No, it's not. Berkshire's a lot simpler to follow than Brookfield, which is very, very complicated. Sure, if you have enough time, you can figure out any business pretty much, but Brookfield is something that your average retail investor is not going to be able to navigate very easily. Well, Berkshire is a complicated business, but much more easier to navigate. Why? Because Buffett's a straight shooter, and it's very easy to follow what he says and figure out what he's talking about. Now, the beauty of insurance, Buffett talks about how customarily firms know the cost of goods up front and they can adjust for that. So one big red flag we have here at Nanalyze would be firms that have a cost of goods sold that's greater than the revenues that they take in. So that means that you're essentially subsidizing a product or service. Regardless, CEOs have a good handle on costs when those are figured out up front. Now, contrast that to the property and casualty insurance industry, or really any sort of insurance provider, where they take the money up front, and that's called float. Then they can invest that, and Buffett makes a lot of money doing that. But they take that money up front, and they don't know the cost until a long ways down the road. So, as Buffett says, much later we learn what our product has cost us, sometimes a moment of truth that is delayed as much as 30 or more years. And that, of course, carries the risk that the company can be losing mountains of money before the CEO and directors realize what's happening. So the type of insurance certainly matters to reduce that sort of risk. Buffett talks about how certain lines of insurance minimize that risk, such as crop insurance or hail damage, in which losses are quickly reported, evaluated, and paid out. However, other lines, he said, can lead to executive and shareholder bliss as the company is going broke, and he cites coverage such as medical malpractice or product liability, what he calls long tail lines. So somebody who's covering this type of insurance can essentially report large but fictitious profits to owners and regulators for many years or even decades. Now, this can be particularly dangerous, he says, if the CEO is an optimist or a crook, and plenty of examples exist of both. So when it comes to the contracts, the underwriting that underpin the insurance industry, he says we want our underwriters to daily come to work nervous but not paralyzed. So you don't want optimists underwriting your policies. He says no private insurance company has the willingness to take on the amount of risk that Berkshire can provide. He says at times this advantage can be important, but we also need to shrink when prices are inadequate. Companies like those under the Berkshire umbrella have loads of big data, which can then be used to feed to AI algorithms and better underwrite insurance contracts. He says we must never write inadequately priced policies in order to stay in the game, because that policy is corporate suicide. He says they're not deterred by the dramatic and growing loss payments sustained by their activities. He says, as an example, wildfires, because the property and casualty insurance business is dependent on increased risk. If there's no risk, there's no need for insurance. So that's actually a good thing. You just need to price that risk appropriately. So insurance is a huge chunk of the two components that make up Berkshire. Wholly owned businesses is the first component. That's where they own 80% or more, typically 100% of a business. And then partially owned businesses. These are typically large publicly traded firms. So when it comes to Buffett's wholly owned businesses, he has, as we said, 189 subsidiaries, which he says have similarities to marketable common stocks but are far from identical. And he goes on to describe these as a few rare gems, many good but far from fabulous businesses and some laggards that have been disappointments. He says, we own nothing that is a major drag, but we have a number that I should have not purchased. That's relatively interesting. The mistakes, of course, are really what you want to learn from. And Buffett talks quite a bit about mistakes in this recent annual report, but he doesn't talk specifically about certain companies that he would describe as being a mistake. And I like this quote here: experience is what you get when you didn't get what you wanted. That's taken from the last lecture by Randy Pausch. And speaking of straight shooters, I highly recommend that you watch that by a notable professor who has 3 months to live and gives his last lecture. The other part of Berkshire's business is Buffett's stock portfolio. He says, we own a small percentage of a dozen or so very large and highly profitable businesses. We're going to look at those. He says, many of these companies earn very high returns on the net tangible equity required for their operations. That'd be an interesting metric to look at, right? He says, understandably, really outstanding businesses are very seldom offered in their entirety, but occasionally, he says, they can sell at bargain prices and can be purchased Monday through Friday on Wall Street. So these are publicly traded stocks that we can all hold. Now, when you look at this portfolio, so these 13 stocks, remember he said roughly a dozen or so, these 13 stocks make up 91% of that second component, the publicly traded stocks that Berkshire holds. Now, looking at these, you have to wonder if Buffett were asked to categorize these as rare gems, good but far from fabulous, or laggards that have been disappointments, what he would say about these. But you can get some indicator, of course, on what he's adding or subtracting from these positions, and that's reflected here in this table. I believe this is simply just one 13F to the next. So when it comes to selling stocks, Buffett says, with marketable equities, it's easier to change course when I make a mistake. Berkshire's present size, it should be underscored, diminishes this valuable option. In other words, it's very difficult for a company as large as Berkshire to just move out of, let's say, Coca-Cola if they wanted to. He says we can't come and go on a dime. Sometimes a year or more is required to establish or divest an investment. He says additionally, with ownership of a minority position in a firm, you can't change management or take a corrective action if a business isn't going as you would like. Going back to that point we made about Buffett excluding earnings of his portfolio of publicly traded stocks, here's a sensitivity analysis, one of a number in the 10K that are worth looking at, where he shows what a 30% increase or decrease would do to his investments in equity securities in 2024. You can see that's either a $62 billion increase or a $62 billion decrease, right? So when you're talking about a roughly $300 billion equities portfolio, a simple 10% change in either direction is $30 billion. That has a big impact in your earnings. So it's totally understandable and should be intuitive why Buffett wants to exclude the movement of these publicly traded stocks from his earnings. But of course, he can't do that at the GAAP level, but he does that in the annual report. It's all rather interesting. Now, when it comes to selling controlled companies, he says we can better dictate decisions about what happens within these firms, but we have far less flexibility in the disposition of mistakes. In other words, it's very hard to sell a firm that you own outright. You'd have to find a PE firm or somebody to take it off your hands. And if there's a reason that you're selling it, Buffett's selling an asset, people will be like, why is Buffett selling this, right? So he says, in reality, Berkshire, and this is interesting, almost never sells controlled businesses unless, he says, we face what we believe to be unending problems. It'll be interesting. There are 189 companies. I suppose you could find out ones that he's exited, but there will probably be some interesting case studies in there. Now, he says, companies die for many reasons, but unlike the fate of humans, old age itself is not lethal. This brings up a conversation we've been having on our Discord server about the age of companies, and some people would argue that older companies have sort of exhausted their usefulness. And I think Buffett is saying exactly the opposite here today. And he actually makes it a point to say Berkshire today is far more youthful than it was in 1965. So people have been talking about Buffett's cash position. I think something interesting came up relating to that. And we did a piece on this, and we produced this chart showing cash in stocks and how the total of those two has been going up, but overall, the percentage of cash has been increasing. We said it's a meaningful move to cash, which may not be over yet, but this is somewhat deceptive, and Buffett addressed that. He says, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities, and that preference isn't going to change. And he says here, the value of our non-quoted controlled equities increased somewhat and remains far greater than the value of the marketable portfolio, which fell from $354 billion to $272 billion, mainly because of a large sale of Apple shares. And what we can then do is look at the balance sheet and compare cash and short-term investments. We total those two compared to total assets. And sure, it's moved from 15% in 2023 to 29% in 2024. However, it still remains a minority compared to the large majority of assets being in either stocks or controlled companies that aren't public. Now, another thing that's interesting to look at is how Buffett talks about this small but important exception to his US-based focus. It's this growing investment in Japan. And since about 6 years ago, Berkshire began purchasing shares in 5 Japanese companies. He lists them out here. He says that year-end Berkshire's aggregate cost in dollars was around $14 billion. Market value is around $24 billion. What's interesting is these don't show in the 13F. I'm not sure why, because foreign stocks should show in the 13F. So maybe that's a question for the class. But he's also taking out fixed interest rate loans denominated in yen. Now, yen's at an all-time low, a real low, which is why I like to go to Japan these days, because it's so cheap, though arguably their inflation's sort of making it not. It's still expensive in Japan. But he says, I expect that Greg and his eventual successors will be holding this Japanese position for many decades. Here's what's interesting. When you look at the type of companies that these are, you go to Wikipedia, they're called Sogo Shosha. Basically, they're what's referred to as general trading companies. I'd like to just say they're conglomerates, but they're a lot more interesting than that, and you ought to give this Wikipedia entry a read because it's very interesting and talks about the benefits of such corporate entities, in particular how they relate to Japan and how they have extensive risk management capabilities and all this internal diversification. Fascinating stuff. The top 5 happen to be the exact 5 that Buffett's holding. Very interesting, right? So this could certainly be a topic to look at in a different conversation. But I wanted to finish this presentation out talking about how Buffett isn't just extremely knowledgeable and a straight shooter and somebody who's very easy to follow. He doesn't try to obfuscate what he's doing in some sort of black magic. It's very straightforward. And I'm going to go ahead and leave you with another piece that we did on Buffett's cash position, reflecting on that. It's all rather interesting. Give that a watch. Thanks so much for taking the time to watch this video today.